Alicia with Seraph. And just to do a very, very quick introduction about us. So our company has two parts. So we have software that helps investors, venture investors, and angel investors manage their investment portfolios and track all the metrics associated with those investments. And we also have the Seraph Compass, which is what this is associated with. And that is our educational hub. It's been built over the last 11 years now. And it's really just kind of education, both written weekly and live monthly on all things venture investing. And so we cover a lot of different topics around the private markets, venture investing, and angel investing from a lot of different angles, I would say. And a lot of the webinars that we do are, some of it is my own curiosity project, because these are things that I'm generally curious about. But we try to do things that are a little bit more topical, whereas the written content, so our weekly blog that goes out, is generally very structural and sort of due diligence templates and ebooks and like 101s on how to get into angel investing and things that are more structural to the industry, whereas these things are a little bit more topical that we do on webinars. So that's plenty about me, but that's what we're all here for. And so I'll do your introduction here, Kerwin, but our first question is for you to elaborate on this. But here we have our lovely speaker, Kerwin Tesdell. I should have asked you how to say your last name, but Tesdell?
Tesdell, you got it.
Tesdell? Okay, fantastic. With CDVCA, which is the Community Development Venture Capital Alliance. And you are the president of the organization. And I think you're a wonderful person to have here to talk about impact investing, because CDVCA, and again, you'll expand on this, but you guys have more than 350 million under management in multiple funds, all of which have some sort of impact mandate or relation to them. You're also a professor at New York University. I think I will have you start out and explain to us how you got into impact investing and how you got into fund management in a broader scale, and then give us more background on CDVCA.
Okay, so educationally, JD MBA, economics undergrad, and always knew I wanted to do this sort of work. I actually started out in civil rights, civil liberties with ACLU, a little work with the ACLU and NAACP Legal Defense Education Fund, but quickly moved into the more transactional work, spent a little time on Wall Street, and then spent 7 years at the Ford Foundation, where I made grants, but also program-related investments. And I started investing, we're reaching back now, 30 years, started investing in these little funds that were popping up literally in different corners of the country, that were using the tools of venture capital to create jobs and encourage economic development in their area. So they formed an association of funds, and I thought they were absolutely terrific and applied for the job. And the rest is history. That's 25 plus years ago.
Amazing. And that was the origin of CDVCA as well? Like that was
So it started out as a member-led organization, and I was the first full-time employee.
Okay, and can you talk to us about where CDVCA is now? Because you guys are
Sure.
huge.
Yeah. So we talk about three pillars of our work. The first is sort of our traditional trade association activity, working with community development venture capital funds around the country and around the world. So these are funds, venture capital funds, that are mission driven, that certainly seek market returns for our investors, but also seek social impact largely through job creation, economic development in lower income communities, basically providing jobs and services for people who don't have significant opportunities in our society. That's the first pillar. Second pillar, then 25 years ago, we started investing. So you referred to that. We've raised and are investing about a little over 350 million. We invest both in funds, in community development venture capital funds, and directly in businesses. The direct investments are often co-investments with our local funds. So we have that network out there in local making investments. We are the managing general partner of several specialized funds. So for example, the Innovate New York Fund, here in New York State, the Puerto Rico Fund for Growth. We have a Puerto Rico office as well as a New York office, and then smaller state funds in 7 other states around the country, and then our what we call our central fund, our national fund. So those are the first 2 pillars. The last one is work with entrepreneurs, but all focused on sort of the same concept of getting equity risk capital to high growth businesses for the purpose of creating financial returns, and then also social returns in the form of job creation, wealth creation, creation of entrepreneurial capacity in lower income communities.
Thank you. Amazing. And that actually leads really well into my first question for you, is that I think that, well, I it seems like there's been a little bit of a whiplash on the impact investing space that over the last 5 years, which I'm sure you've seen, but you guys have been around quite a bit longer than that, right? Like, so you've gone through the whole up and down. But how do you think people can best balance the mission-based objectives and the financial based objectives? Because I think a lot of times those are misaligned for folks. And then when we had a bunch of, quote unquote impact funds pop up, and now a lot of the people associated with DEI, and I don't need to tell anyone on the call about what's happening in the United States. It's just a lot of weirdness politically. And so how do people balance, like if they wanted to continue to focus on the impact metrics, how do you balance that with the LP returns and what you're supposed to be doing is like if you're a purely financial fund?
Right. So first of all, yes, we've certainly experienced some of that whiplash coming from the federal government right now. But on your basic question, first of all, I think it's important to point out it's not like there's this tremendous trade-off, right? That either you produce the financial returns or you produce the social impact returns. For the kind of work we do, the job creation, the economic development, those two really go together. A successful company, a high growth company produces, fits into the venture capital financial model, but it also, if it is successful, and we focus on the types of businesses that, are likely to produce significant numbers of good entry level jobs. If the company's successful, it will create those jobs. It'll create the wealth opportunities in the communities. Now, one thing we do is we go to places and we sometimes invest in industries that, if you're sort of a Silicon Valley VC looking for top level returns, Puerto Rico might not be the first place you'd look. And I say that with deference to my staff in Puerto Rico. Sorry for saying that. But our work in Puerto Rico is to find companies that are high growth, that will be financially successful and will therefore create the jobs that we're looking to create, and particularly the high quality employment opportunities that we're looking to create.
So that's really interesting to me, because I think that people, it's being framed more publicly that it is an either or. And that sometimes, and I don't think, personally, I don't think it's an either or. I actually think that there's well, my own opinion, but I think that there are decisions that you weight the decisions differently as a fund manager when you're optimizing for certain things, and that is very normal. But your point that it's not an either or, I think is prudent. Can you give an idea of the kind of metrics that you guys are tracking? Because I know that there's a place-based component, and you've spoken to the idea that job creation is really important. Are you tracking different metrics for different funds, and how does that relate on a tactical basis? What do you guys tracking? What do you consider like your North Star guiding metrics for that is successful to you?
Right. So it's somewhat different for different funds, and that's really driven by our investors, our sources of capital. Like anyone else, when your investors ask for certain things, you deliver. But the basic metrics we use, we have a set of, it's about 115 impact data points, and they generally fit under the category of job creation. We measure job creation, job quality. Do the jobs pay a living wage? Do they offer medical benefits? Do they offer wealth building opportunities through a 401k plan or a ESOP or other kind of ownership opportunities. So jobs, job quality, and then there are various metrics because we're interested in the impact more generally on the local economy of what's happening with sales. Sometimes when you're dealing with funds associated with government, you're interested in taxes paid. The local governments are very interested in those kinds of metrics. So the sort of success of the company. So job creation, job quality, success of the company, and then in some cases we have some particular focus such as greenhouse gas reduction, and obviously we would be measuring that as well.
And how did you guys go about defining, like, so that number of metrics that you're tracking is very large. How did you go about defining each of those segments? And not to take you back 20 years when you guys probably actually defined them, but could you just talk me through it as if I was like a new fund manager and I wanted to say, this is the goal, what we're trying to create. How would you go about segmenting and splitting apart? And depending on the stakeholder, those are going to be different metrics, I think. And could you maybe just give some advice for folks who might be interested in setting up a process, even if it's not. I think that the impact tracking is really important. And again, just my opinion, but I think it's important for all funds, whether or not you have like a quote unquote impact focus. And so measuring your impact is something that everyone should be interested in doing, whether that's financial or not. And I think best practices around doing that, measuring like what impact your investments is having, is important. So from that perspective, could you offer some advice?
Sure. And I should say my headphone's telling me my battery's low, so I hope that I don't go out in the middle of this. But if suddenly I take this off and try to switch, you'll understand why. I would say for us, everything starts with mission. We define clearly what we as an organization, as a fund manager, what impact we're trying to accomplish. And as I said, we certainly want to, we have to listen to our investors, to understand what they're interested in. So for example, if we have a bank that is getting Community Reinvestment Act credit for investing in our fund, we have to produce the data to allow them to go to their regulators and do what they need to do. But beyond that, you're right, 115 is a large number. But if you look through the questions, they're not, they're it's not sort of a 115 totally different concepts. But again, as a mission-driven organization, we really try to understand what affects workers, what affects their families. I described the 401k plan, the medical benefits, et cetera. And I think that comes from, many years of experience sort of really diving into what affects people's lives. And that's ultimately what we're interested in is improving the lives of the employees of our companies and their families.
Thank you for that. And I think the one metric, the jobs creation metric and associated wealth metrics, is, I think all venture funds should track that, frankly. Like that's always my example when I do demos of our software. But I think that's helpful generally for folks who are trying to figure out how to track those and how to define them. Can we talk a little bit about how you guys are actually collecting data? Because what we try to do here at Seraph is give people, playbooks and references for how they can actually execute these things. So if someone has, even 10, like a lot of the angel groups I talk to really struggle to collect KPIs from their portfolio companies. And I imagine you guys across many different funds with that many more metrics, right? That 10 times the amount as what I would consider a normal portfolio manager. How are you guys collecting this? Do you have advice for people on reaching out to founders? Like, is there mandates when you invest for information rights, like those kinds of things? How are you guys actually collecting data and then analyzing it?
Yeah, that's a large question that obviously we've developed over 30 years, and this gets a little bit into the technology and so forth that I know that you're interested in, but the evolution just in terms of technology of how do we do it? We started out with Excel spreadsheets and sending Excel spreadsheets to people to fill out and lots of time consolidating worksheets and things like that. And actually a lot of our data is still in Excel worksheets. The the new technology, I'd say over the last 5-10 years has been more cloud-based. So how do you sort of same information, but gathering it in the cloud and getting it into format that's easier to analyze. And I think the next, the next step that we're currently discussing and looking at is obviously AI and what that might offer in the future in terms of that, sort of interface to be able to get the kind of information, and in a form that you can really use it. And another thing I guess I would add is it's a challenge sometimes, as a fund manager, because the businesses and so forth, is it good that 80% of your companies have retirement plans? Is that a good number, or is that a high number? Is it a low number? So you want data, overall data, or is the wage that's being offered by the company, is that a living wage? So we happen to use the MIT Living Wage Index to compare, to have some kind of context for the data that we provide. And that's sort of another challenge, I think, in providing the data.
That is one that I actually didn't think about, that all of your data, not only do you have to collect it and analyze it, but then you have to, is it meaningful relatively, right, to
Right.
industry? That's, yeah. Okay. And can you expand a little bit on the process there? So are you guys doing this quarterly? Do you do it annually? And then your
Yeah.
people stack it, just because I'm curious,
Right.
like if you have split, if that's a fund manager job, or if you have an analyst across funds, just because, curiosity from an operations standpoint.
Right. Right. So we have a couple of people who are really dedicated to the data gathering. One of them is on our investment committee, so very much, involved and has been involved with, the overall operation of the fund to have that context. Obviously involved with reports to our LPs and so forth. So that's on the person side. And then I'm sorry, you asked about,
Oh,
was that
cadence
the
for
question?
reporting. Yeah, it was like who's doing what, and then the cadence for reporting and how
Oh,
that, if
cadence,
it's,
right, right.
yeah.
So cadence, we get quarterly reports from all of our investees, both funds and businesses, but the social impact data we do annually. And that's simply a matter, there's a trade-off, right? You want the information, but you don't want to be too burdensome. You don't want your company spending all their time, gathering data for you instead of running their companies. So we gather data at the point of investment and then annually thereafter.
Okay.
So that we have, longitudinal data.
Yeah. Okay. Fantastic. Thank you. That's helpful. And I've seen some, we interface with a number of emerging managers, like particularly in Africa, that are trying to figure out what their cadence should be. And some of them have trended towards monthly. And my feedback to them is that I think it's going to be very difficult to do this monthly, especially because even if you can get the data monthly, which is hard to do, it's hard to create trends monthly. Like you're forcing a growth
Right.
that is not natural, I think, to like what the overall investment class is. And so that's helpful. Next question for you. What most common mistakes do you see when people are trying to track the quote unquote impact of their investments? And this one I would like to be a little bit more broad too, because we have a lot of the angel networks that I interface with and a lot of the individual angels. People are, in my view, people are investing for returns, but not just returns, right? If they're investing only in angel investments, so in VC investments or VC type investments, it wouldn't be just for returns, just because that timeline is so long. And so they're doing it
Hmm.
for other reasons. And a lot of that, to me, seems like impact, right? They want to impact their
Hmm.
local communities. They want to impact
Yep.
a certain type of founder. What mistakes do you see when those people are trying to deploy capital and then track the metrics thereafter?
Right. So, you want to start off again with why are you doing this? Both why are you doing this and why, particularly if you're a mission-driven organization like ours, and then, you know, what are the interests and needs of your investors? In terms of mistakes, I'd say a big one is this is hard to do, right? It's hard to raise capital, it's hard to make investments, it's hard, there's so much to do to run a fund effectively. And the there's a tendency to sort of build the impact measurement system as you go, sort of build the plane as you fly it. And you get it. That's not a good thing because for one thing, you want longitudinal data. So if you keep changing, if you keep adjusting, you learn as you go. And I'm speaking from personal experience here. You learn as you go and you think, oh, we should have asked this question instead of that question, and we should word things differently and so forth. Then, you keep changing things and you don't have comparable longitudinal data over time. And the same thing from fund to fund. You have different investors, you have different places, so the tendency is to sort of create your system each time you create a fund, but then you want to be able to say something across funds. You want to be able to compare data. And if you keep changing things, you can't do that. So that's the challenge. Obviously, you want to be a learning organization. You want to adjust as you learn. But if you do too much of that, you don't have comparable data. And I think what that argues for is a lot of careful thought up front, probably when you don't have a lot of time for that careful thought because you're trying to create your fund and you're trying to raise your capital and all that stuff.
Yeah.
And that's I guess a luxury of having been at this for 25 years. We've we've ironed a lot of that out, and we try to share that learning then and experience with our member funds.
And do you think that a lot of other organizations that would be qualified as like impact investors, so not necessarily VC investors, but the, people that are deploying grants, right? So like, do you think they follow the same general workflows that you guys do in terms of tracking their impact?
Yeah, yeah. I mean, grant makers should be gathering that data also. I mean, I'll say one thing, having worked at Ford and having uh, made grants and investments, it it's a lot easier to get your investees to answer questions and take it seriously than the grantees, because the grantees are like, I'm doing good, give me the money. You're distracting me by asking too many questions. The investees are like, okay, I get it. You want your money back. So I need to answer your questions because you have a legitimate interest in knowing what's going on with me. So, and and I think you do have that basic financial information, right? Which is very much related to your social impact information. It does matter what your sales are and what you're contributing in terms of taxes and things like that. So yeah, I mean, I think gathering information for both grants and investments is important, but interestingly enough, I've found the uh, investment data richer. That
Hmm.
relationship between investee and investor as opposed to grantee and grantor.
Okay. Thank you. Thank you. Because I think the universities are one that come up quite a bit that are both doing grants and then they have like an angel fund or some sort
Hmm.
of angel network that's attached to it. And so I think that's
Right.
interesting context for a lot of people. Next question for you. So over the 25 years that you guys have been doing this, when we talk about longitudinal trends, have you seen anything that was particularly surprising to you or revealing to you about the impact that you guys have made, or and any trends that you think that are interesting and curious and worth sharing?
Yeah. One thing is it's sort of amazing looking at back over 25 years what the impact's been. I mean, just the tremendous job creation, the number of businesses we've affected. It's nice to be able to look back and see, literally tens of thousands were, up in the hundreds of thousands now of jobs. In terms of, sort of surprises, I mean, one thing I'll just mention, I spoke to the person who's really, you know, in in the thick of gathering the data yesterday about this, and one thing she pointed out was that we have one fund in particular in a place that doesn't have a lot of venture capital. That's why we're there. So we ended up, we had $45 million to deploy there in funds and in businesses, but primarily in funds. So there weren't enough venture capital funds to invest in. So we invested in some debt funds, and we're seeing the measurement of the job numbers actually higher in the debt funds and the equity funds. But I think that's just an artifact of measurement, right? You make a small loan to a large hospital, and sort of the convention for measuring jobs is you take credit from for everything that happens in that hospital from the time you made the loan to the time that uh has my speaker changed? Yeah.
It has, but it still
Okay.
sounds
Yeah, I
just as
just
good.
ran out of the battery. So I personally, I think the impact of the equity funds is stronger because you're really, sort of that but for question. If we hadn't made this investment, what would have happened? I mean, we're really responsible for, companies that wouldn't exist but for our investing and our activity. But just the way the measurement is done, the the debt numbers sometimes look more impressive.
Do you guys have multiple debt funds that you have invested in as well as equity funds, or is this just a unique case in that particular location?
Yeah, it's almost all equity. It's this particular fund in this particular place where there just weren't enough equity funds. So we pivoted and adjusted and did some of the debt funds. And we tried even in that investing to it's more sort of mezzanine debt, more higher risk kind of stuff. So it's more impactful debt.
Mm. Okay, that's interesting to me too because I debt like private credit and debt it seems to be I can't I don't know how to put verbalize it, but doing something interesting in the markets now
Yeah.
that
Yeah.
equity is like is struggling a little bit, and I think there's debt funds. We see a lot of it internationally, but it certainly seems
Yep.
to be something like the revenue share type debt things that are coming up
Yep.
in startups
Yep.
here. So
And I'll just add, I mean, we did something that's sort of unusual, I think, in the impact investing world, which is we invested in funds. We are limited partnerships, limited partners in private debt funds. In, for example, the US CDFI world, almost all the capital, first of all, the CDFIs are structured as not-for-profit organizations, so they don't have LPs. And the debt, the capital comes in as debt on the balance sheet of the entity, which often means that it cuts down on the flexibility of deployment for the fund because you have this debt due, right? You've got this cash. You have to repay the loan usually. I mean, depending on the terms of the loan, you have to repay the loan. You generally have a lot of covenants, that don't allow you to be as flexible as you might otherwise be. And we as equity investors, I mean, we believe in equity. We believe in providing flexible capital
to businesses, but we believe in doing that for fund managers as well. So when we are equity investors in a fund, that allows that fund to operate in a freer way, I guess, than if we were a debtor into that fund.
That
But
is
then
a
the money that comes out of the fund, in those cases, it was debt rather than equity.
that is a really interesting insight, because I didn't think about it's gonna that the fact that the credit funds, especially the CDFIs, are going to trend towards the most conservative investment in that case, because they have debt themselves that they need to pay. That's really interesting. Thank you. I'm gonna cut that into a short clip and post it on my LinkedIn. Like that's really important. Thank you. And you guys, we're probably halfway through our time here. So I see, Melissa, you've submitted a question. We'll get to those at the end. So anyone that wants to can start submitting questions in the Q&A, but I'm gonna continue with a couple more of mine. How do you avoid impact washing? And the term impact washing, I think more likely people have heard greenwashing, where the big corporations said that they want to have an environmental impact positively, and they're doing all these things, and then that didn't really pan out in I don't say most cases. In a lot of cases, it seemed like some corporations were accused of just like, hey, you said you want to do this thing and you didn't do this, and you just did it for fanciful branding, basically. How do you guys avoid that, outside of, I suppose, the obvious like tracking and reporting on your results?
Yeah. So I guess, again, you can think of it at several levels. At the fund manager level, I guess one piece of advice I would give to asset owners, those who are providing capital to funds, to businesses, et cetera, is invest in mission-driven organizations, right? Because the non-mission driven organizations are doing this to get the capital, right? So they want to produce, and I'm frozen on my screen. I don't know whether I'm
you're frozen on mine. Your audio is not.
Okay.
Your video
Okay,
is.
I'll keep talking.
So
then.
you can keep going.
So let's see, Zoom not responding. You can still hear me?
I can still hear you, yeah.
I wonder if I should just, maybe I'll turn off my video. Well, it's not even letting me turn off my video. Okay. So I think investing in mission-driven organizations is important. And, it sort of avoids the impact washing. In terms of the data that we collect, we're long-term equity investors in our business. They've already gotten our money. So I actually don't think, and I had this discussion with my staff recently, I don't think they're doctoring their numbers, because I don't think they have a reason to doctor their numbers. They see us as an investor in their business like any other investor, and we've just got this extra information that we're asking for. So I don't think we experience the greenwashing or the impact washing. But for the asset owners, as I said, I think when you've got a mission-driven organization, they're going to try to have the impact no matter what, because that's their job, that's in their DNA, as opposed to, oh, we have to produce certain numbers for our investors.
Okay, thank you. Next question here. So looking ahead, you guys have been around for a long time, and so I think you've probably my question is about the next 5 years, but maybe I'll expand that to the next 10 years, just because you've got such a long expertise in it. What trends do you think are going to shape the next 10 years in impact investing? And you can take this, because you guys are international. Well, not, I suppose Puerto Rico is still but intercontinental, we'll call it. What trends do you see, both, here in the continental body and internationally? If you have any perspectives on what's happening in Europe or Africa or South America, any of those I think would be welcome. I'm very interested in what you see as the expert in the space in terms of impact measurement.
Sure. I am seeing more interest in equity. After 2008 and the Great Recession, nobody wanted to hear about risk for quite a while. And now, the pendulum is sort of swinging back, and I think people are appreciating what risk capital, flexible risk capital, will do in the capital stack, whether it's a business or a real estate development or whatever. And by the way, we do work internationally. It just, most of our investments are in the US, just because that's where we've gotten our capital. But we're We're certainly interested on the association side. We're interested in funds that are outside of the U.S. So yeah, I mean, I think the equity, I think, certainly the environmental climate investment has been a major area. And at least in the US right now, that's, the government is really working against that. I guess the other one I would add, again, domestically, and again, this relates to the current administration, is the whole, I guess, what you might call DEI. We always saw this, CDVCA always saw what you might call DEI in the context of underinvested communities. And, in the United States, you can't discuss underinvested communities without looking at race to some extent. I think because of what the administration is, the positions the administration has been taking, which, has filtered down to universities and, everybody, it's prompting perhaps a deeper look at, why are we interested in DEI, right? Beyond just like counting numbers of, people of a particular race.
And I actually wanted to double tap on the question you're saying about how the federal government is impacting things. And I was interested how much you think that, I think it's almost certainly going to be detrimental. I'm curious how detrimental you think it's going to be for the impact investing space, and like just the general allocation of like investments and grants, and the flow of money is kind of been, at least to my eyes, been rerouted a bit.
Yeah.
And so I'm curious your thoughts on how big of an impact this is going to have.
Yeah, well, there's certainly some direct impact. We've got $25 million sitting in a frozen bank account, for example, right now, as a result of all this. So there's some direct impact, and then I think the other impact we're seeing, and we'll just see how this plays out. But I think right now among private sector investors, and I'm talking now within the United States, foundations, banks, et cetera, there's just a lot of uncertainty, right? And there's been, people are scared. They're worried that, investing even around in the neighborhood of what the administration might feel is DEI or climate or, whatever disfavored, or ESG or whatever disfavored activity there might be, people are worried that they're going to get, painted with that brush. And we'll find out. Hopefully, well, I'm old enough to have seen the political pendulum swing back and forth, and we're certainly, on one end of that political spectrum. But I think also in the private sector investors, there's just a lot of change and uncertainty in so many ways right now as a result of what's going on in Washington, and hopefully that's going to settle back down. And some investors are doubling down. Some investors are saying, hey, the federal government is withdrawing from certain very important areas, and we're going to double down, and we're going to put more resources into those areas, which is wonderful.
Yeah, that makes sense. Thank you. So I think let's move on to a couple of the questions that we've got here, just to make sure that we get to them. So the first question: in these days of AI, when job creation may not be the indicator of startup success that it used to be, are you tracking newer metrics like revenue per employee? And from an economic development impact perspective, if there are fewer jobs, but the companies are still successful, what other metrics of community impact are you capturing to ensure that you get the full picture? Which is a wonderful question, just given, efficiencies.
Yeah. So, those are sort of macro issues, and we certainly pay attention to those macro issues. We like to understand what's going on in the economy. We like to understand what's going on in local communities. And I'll just add, in terms of understanding what's going on in the local communities, that's one really important thing we bring to the table is our association activities. So we have all these local funds, in communities all around the country who are really, have deep roots in their communities and understand what's going on. But as I was saying, I think the macro questions are important, but a wonderful thing about being an investor is you're brought down, you want to think at the 30,000 foot level, but then you're brought down to the 3 foot level, right? When you make investments, you're looking at individual companies. You know, you get to know the company well, you walk around the company, you see who the employees are, you hear the story about the woman who was came in and was working on the assembly line, and now she's ended up as CFO of this growing company. So it's really that micro level information that ties us to the impact that we're having, whatever's going on the macro level.
Thank you. Next question here. So is there an intake form that prospective investees fill out that includes projected impact data? If so, is it through a Google form, or what system is preferred? So I think we're asking mainly about the actual mechanism of application here, but I'm also curious if you guys take into account projected impact data when you're evaluating, like if your diligence is influenced that way.
We absolutely do. We absolutely do. So we ask all of our investees for projections of job creation, what kinds of jobs, et cetera. And then we look at, how they, in the same way that we look at how they're performing financially against their projections, we look at how they're performing in terms of impact. I mean, there are folks who have, covenants that require certain number of jobs, that kind of thing. We don't do that. I think the philosophy is our companies are trying to grow as rapidly as they can. And if they're not hitting their financial targets or their job targets, having a legal agreement isn't going to make a difference, right? But no, we look for companies that, if they are able to perform on their business plans, they'll be financially successful, but they'll also be successful in terms of job creation. And we think it in advance, in the same way you think in advance about the financial results of your investment, we think in advance about the social impact of our investments. And I'll just add one thing there, that, if you're a lender, that tends to be a more arm's length relationship. As an equity investor, we're literally in the boardroom. So we can have an effect post-investment. It's not just, providing money and, good luck, please create a lot of jobs. We can actually help them with particularly job quality. And that's one area that we're really looking to develop more, is how we can help our investees, both our funds and our businesses, post investment, to have greater impact.
Do you guys, while we're on the subject, do you guys typically take the standard board seat, and are you right now, how heavily involved would you say that you are?
Yeah, we do in some cases, and we don't in others. As I said, we often co-invest with local funds, and in that case, if we're happy with the relationship and so forth, we'll look to the local fund to take that board seat. They're going to be better at it than we are, and with the funds we invest in, we tend to take advisory board. I mean, almost always we'll take an advisory board position, because I think we can really add value there. But sometimes we take board seats. I mean, I'll tell you, it can be a tremendous time sink, and there are different philosophies. I heard Alan Patrikoff, who has about as much experience in venture capital as as anyone on earth, say he now thinks, he never takes board seats. He takes observer rights. And some of that is, legal liability. We've had our experience recently with that. So, there is a downside to the board seats. But whether you've got a legal board seat or not, these companies live and die on, whether they get the next round of investment from you. So they listen to you. whether you're sitting there in the boardroom or not. And if we can add value through helping them think about their medical benefits, their 401k plan, whatever. First of all, they listen to us because we're investors, but we're adding value in that case. I think usually what we see is entrepreneurs who, it's not like we're forcing them to do anything in terms of job quality. They really want to do that. And if we can facilitate that, you've got an entrepreneur who's like running his company and trying to figure out the next contract and raising money and et cetera. And if you can help him deal with the retirement plan issue, that's value add. That's not forcing the entrepreneur to do anything she or he wouldn't do otherwise.
Okay. Thank you. And I think final question for you here, because I've got nothing else in the Q&A. What are you most pessimistic about, and what are you most optimistic about in the upcoming 5 years? And then we have one. Yeah, well, ignore here. I'm going to just insert this one question here just because I think it'll be quicker. What system is preferred for data collection?
I'm sorry, what preferred?
What system is preferred for data collection? We had to have one more question on the systems that you guys may or may not be using.
Yeah.
Do you have any recommendations?
So I mean, it happens to be UpMetrics that we're using right now, but we've got a cloud-based system, and we're just starting to look at AI overall for the organization, for everything we do, not just for our investing and impact reporting. But, I think that's the next frontier. And then, but there was an earlier question that, pessimistic, optimistic.
Yeah, pessimistic, optimistic.
I can't answer a question about pessimistic without talking about what's going on in DC right now. I mean, that's we'll see what comes from that. And I think in terms of optimistic, I've been in this field for a long time. It has progressed tremendously, not just in terms of size, but in terms of sophistication, in terms of impact. And that's not going to go away. This field has grown for a reason, because it is so impactful, and I expect that we will be growing in the future. Whatever the bumps in the road, the current bumps in the road might be.
Amazing. Well, that is a lovely way to close out with some optimistic perspective. Thank you, everyone who has joined us today. Again, this recording, we'll edit it a little bit, and then we will send this out in about a week or a week and a half to everyone who's registered, and then everyone who's subscribed to the Serif Compass. So thank you, Kerwin, for joining us. I know it was a little bit last minute on our end, so my apologies, but I appreciate your perspectives, and I think that this will be genuinely helpful for people who are trying to set up things that are like relative to tracking impact that their funds and their investments are making.
Great. Happy to do it. Been a pleasure.
Thank you. Have a good rest of your day.
Okay. Bye-bye.
Bye-bye.